Building wealth begins with mindset, not money. For many Australians, there exists an invisible barrier called tall poppy syndrome, the tendency to criticize those who achieve financial success. Understanding this pattern is the first step toward breaking free. The transition from an average income mindset to an investor mindset requires recognizing that wealthy individuals think differently about money. They view every dollar as a potential employee that can work for them, generate returns, and multiply over time. This psychological shift involves moving from what can I buy to how much can I invest. This isn't about deprivation, it's about delayed gratification and understanding that today's sacrifice can become tomorrow's freedom. Many people remain trapped in the income illusion, believing that earning more automatically leads to wealth. However, income and wealth are fundamentally different. Income is what you earn. Wealth is what you keep and grow. Someone earning $80,000 annually who saves 20% is building more wealth than someone earning $150,000 who saves nothing. Human willpower is unreliable for saving money. The solution is automation. Pay yourself first. Before rent, groceries, or entertainment, a predetermined percentage of your income should automatically transfer to savings. 10 to 20% is a common starting range. For Australians, superannuation represents a powerful tax-advantaged wealth-building tool that many overlook. Most accept whatever default fund their employer selects, never questioning if it's optimal. This passive approach can cost tens of thousands over a career. Consider this educational example: a fund charging 1.5% in annual fees versus 0.7% might seem minor. However, over 30 years, that 0.8% difference can reduce your final balance by hundreds of thousands of dollars due to compound effects. Optimizing your superannuation involves comparing fee structures, understanding investment options, checking historical performance, and ensuring contributions align with your risk tolerance. Younger workers might choose higher growth options, while those approaching retirement might prefer conservative allocations. Before building wealth, stop the financial bleeding. High interest debt functions like a reverse investment. You're paying substantial amounts to someone else instead of building your own wealth. In Australia, credit card interest rates frequently exceed 20% annually. Buy now, pay later services, while marketed as convenient and interest-free, often encourage overspending. These products are engineered to keep you paying, not to support your financial independence. Here's an educational perspective. If you're carrying $5,000 in credit card debt at 22% interest, while trying to invest with average historical returns of 7 to 10%, you're losing 12 to 15% annually. The avalanche method suggests paying minimum amounts on all debts except the highest interest one, which receives all extra payments. Once eliminated, redirect that amount to the next highest interest debt. Alternatively, the snowball method targets the smallest debt first for psychological wins. Buy now, pay later services deserve special attention. Research shows they encourage people to spend 30 to 40% more than traditional payment methods. Creating a debt elimination timeline provides clarity and motivation. Once you've established the right mindset, automated savings, and eliminated high-interest debt, you're ready to explore investment vehicles. For most people, low-cost index funds and exchange-traded funds, ETFs, represent the most sensible starting point. An index fund tracks a market index rather than trying to beat it. On the Australian Securities Exchange, ASX, popular indices include the ASX 200 and ASX 300. Research consistently shows most actively managed funds fail to outperform market indices over long periods, especially after fees. Yet they charge significantly more for this underperformance. ETFs function similarly, but trade like individual stocks, providing flexibility and often lower costs. For Australians, ETFs tracking the ASX 200 provide exposure to Australia's largest companies. Global ETFs offer diversification across international markets. The key advantage is diversification. Instead of risking money on a few individual stocks, index ETFs spread risk across hundreds or thousands of companies. If one company fails, it represents a tiny fraction of your total investment. Cost matters enormously. An ETF with a management expense ratio of 0.07% versus an actively managed fund charging 1.5% makes an enormous difference over decades. That 1.43% difference can mean the difference between comfortable retirement and financial stress. Many Australian platforms allow ETF purchases with minimal balances. Some offer regular investment plans where you can invest small amounts monthly, building positions over time. The final piece involves not relying entirely on employment income. Income diversification means creating multiple revenue streams, so your financial well-being doesn't depend on a single employer. Side businesses represent one avenue. The digital economy has created unprecedented opportunities for Australians to offer services, create products, or build audiences outside traditional employment. Many successful ventures begin as weekend projects, gradually growing until they provide meaningful supplementary income. Investment income represents another stream. As your portfolio grows, dividends from shares and distributions from ETFs begin providing passive income, money that arrives regardless of whether you worked overtime or changed jobs. Property investment remains popular in Australia, though it requires careful consideration of deposit requirements, ongoing costs, vacancy risks, and market conditions. Educational awareness of concepts like negative gearing helps in understanding the landscape. Though individual circumstances vary enormously, the principle underlying diversification is resilience. If you lose your job but have a side business and investment portfolio, the crisis becomes manageable rather than catastrophic. Financial independence isn't about having millions, it's about having options. Building multiple income streams creates a financial flywheel effect. Employment income funds investments. Investments generate passive income. That passive income can fund new ventures. Each component strengthens the others, creating momentum. Understanding these 5 components provides a framework for thinking about personal finance differently. The psychology shift breaks you free from limiting beliefs. Automation removes willpower from savings. Debt elimination stops financial bleeding. Index funds and ETFs provide accessible, low-cost vehicles. Income diversification creates resilience. None of this constitutes personal financial advice, as everyone's situation differs significantly. However, understanding these concepts empowers you to ask better questions and make more informed decisions about your financial future. The journey from average income to financial independence isn't mysterious. It's a learnable process built on consistent principles, disciplined execution, and patient capital accumulation. The most important step is deciding that your financial future deserves intentional attention rather than passive acceptance.